Oh, that's real good.
Hello everyone, and welcome to our channel Penny Lesson. We talk about everything finance, from tips on making money and proper investing to news about the different economies and situations affecting the global markets. The goal of this channel is not only to teach you how to be more financially responsible but also to teach you how to be more aware of global events. So why not just sit back and relax while we tell you what's happening in the finance sphere? Be sure to subscribe to my channel and hit the notification bell to be constantly updated on my latest videos. Remember, one penny lesson a day keeps being penny less away. In this video, we talk about the strategies used in investing by the big shots. Before we get to that, however, we must first understand recession, the bear and the bulls, and many more facets that comprise the whole field of investing. So sit back, relax, and listen to what we have to say because this might make you one step closer to being richer than where you are now. We've had it quite easy in terms of financial markets over the previous 10 to 15 years. It's fair to say, this 500's earnings have almost doubled as its price has tripled during the last 10 years. Before what is happening now, the highest federal funds rate was just 2.5%. Therefore, it has been a favorable time for investors and enterprises. Due to the low cost of money, it has been simple for firms to develop, valuations to increase, and investors to profit. Everything you bought seemed to double quickly at the end of 2019. Of course, the bubble eventually popped. The pandemic caused pandemonium around the world. As a result of business closures, the financial markets crashed. The investing world was brought to its knees by the protracted and gloomy recession. In truth, the world's central banks intervened, produced trillions of dollars, distributed them to companies and consumers, and then merely kicked the problem down the road. The game of printing money to save us can no longer be played since we have now caught up to the can, and inflation is reaching roughly 40-year highs. As we have seen, the Federal Reserve has recently begun sharply boosting interest rates, making it harder for people and businesses to acquire credit and putting the brakes on the economy. And, to put it mildly, it's given the financial markets a little trouble. Cryptocurrencies were obliterated. Falling real estate prices. Popular companies are currently having trouble. The stock market also appears to be in really bad shape. Fearing that the severe recession we had to have been in is finally here, investors are selling up. However, despite everything that has occurred so far and everything that will occur over the next year or two, this could be the ideal period of your life to advance and amass wealth. So let's discuss why this moment is so significant and how you can take advantage of it. More than most people understand, investment involves a lot of psychology. Of course, buying low and selling high is the basic tenet of investing. But in practice, the majority of individuals do the complete opposite. They purchase high and then sell low, even though they don't mean to. When things are hard, fear, uncertainty, and doubt drive them away from the market. It's a fascinating phenomenon, and the key factor contributing to this backward mindset is that most people lack specific investment objectives and a long-term time horizon. As a result, when the economy begins to tank and the news becomes unfavorable, many choose to flee rather than take advantage of this enormous opportunity. But in actuality, that is a bad tactic. Here, have a look. This timeline illustrates the bull and bear markets in the United States since 1926. The recessions are the large out bars, the bull markets are blue, and the bear markets are orange. There have been 15 recessions and 11 bear markets since 1926, making a total of 12 if the 2020 decline is included. There were 14.7 years of bear markets and 75.4 years of bull markets to go along with that. Consider how infrequently these terrifying occurrences occur where you feel like the world is ending. And as you can see, if you have the guts to invest at these times against the grain, you're frequently amply rewarded. Just look at the profits you made after the Great Depression, 265% over 4.4 years. Following the subsequent bear market, you gained 43% in 1.8 years, 210% in 4.1 years, 908% over 14.8 years, and so on. It does demonstrate the size of the opportunity that a bear market might present. For instance, you would have earned roughly 9% on your investment if you had made it at the market's peak before the 2020 decline in the price of crude. However, if you had chosen to invest at the market low, which occurred only a few weeks later, you would have made about 60%. That illustrates how important your entry point is. And keep in mind that these significant declines are quite rare, as seen by the prior chart. 75.4 years of bull runs and 14.7 years of bear markets. Rarely do we have opportunities to endure some discomfort for long-term gain. Yes, recessions do make for great investment opportunities, but how can I take advantage of this chance without ruining my portfolio? The first step is to stay informed, but it's crucial that you effectively carry out your investing strategy when you notice market volatility. As we all know, there are two basic approaches to long-term investment, either dollar cost averaging or long-term value investing in the vein of Warren Buffett. And you can bet that the majority of people will choose option one. They'll decide on dollar cost averaging. For those who are unfamiliar with dollar cost averaging, it is essentially the process of diversifying your investment portfolio across the whole stock market using an index fund. For instance, SPY is the largest index fund in the entire world and is the traditional SPY 500 index fund. As a result, they pick a market tracking investment, and from that point on, they will consistently spend the same amount on that market tracking investment. Therefore, your money through that index fund gets distributed over the entire market for something like $2,000 every 6 months or so. By eliminating all emotion from investing, this technique nevertheless allows you to benefit from the market's long-term success, which for the SPY 500 is roughly 10 per year. However, you are not required to read yearly reports or worry about your investments in any way. At first glance, this technique doesn't appear to involve timing the market or focusing on the incredible opportunity that is a stock market crash. However, you already are. Because of this, $2,000 won't purchase you as many shares when the stock market is very high. $2,000 bought you 12.78 SPY shares on October 9, 2007. However, a year later, as the market was collapsing, you were given 20.5 shares for $2,000. Naturally, you'll purchase a lot more shares at a lower price and a lot less at a higher price. However, you haven't needed to alter any of your investing practices. I, therefore, favored dollar cost averaging, which is a very real method by which passive investors take advantage of a significant market drop, simply by carrying on as they always have. But in addition to passive investing, many investors like to have more control over their portfolios and prefer an approach more in the vein of Warren Buffett, where they buy specific firms. They are aware that they possess significant competitive advantages. Their management teams are excellent. Naturally, they are priced with a margin of safety. As that would take a lot of time, I won't go into the entire strategy in this video, because that is precisely the topic of the introduction to stock analysis, which you can watch over on profitability through the link in the description if you would like. It would take around 8 hours. However, I did want to mention in this video how those active investors may ensure they won't lose money when investing during this uncertain economic period. And the first thing we need to consider is, well, what's happening right now that is hurting businesses? And the two biggest issues currently are rising interest rates and excessive inflation. Therefore, costs are higher, debt servicing is more expensive, and consumer spending is declining. How, therefore, can you be sure that a company will be able to survive in such a setting? First off, the company you are considering must have the ability to pass on prices. We recently discussed this. Pricing power is the ability to raise prices without seeing a decline in sales due to their competitive positioning. For instance, because customers are already spending less on discretionary things, many businesses are currently forced to lower their pricing. However, companies like Coca-Cola have such potent comparative advantages that they may raise prices without decreasing sales. Despite raising pricing, they saw an 8% gain in drink sales and a 4% increase in concentrate sales in Q2. And in an era of inflation, this quality is essential for success. Customers don't incur any negative effects as a result of the rising prices faced by Coca-Cola. Thus, the primary quality that prevents inflation is that. However, the current rise in interest rates should also be taken into account. Of course, the main impact of increased interest rates is an increase in the cost of refinancing debt. Therefore, keeping your company's debt levels low is the greatest approach to ensure that it survives this period well. Google, for instance, has more cash than debt. Just 0.05 is their debt-to-equity ratio. They pay less interest than they take in. Even better, Meta owes nothing at all. As Peter Lynch would say, it's very difficult to close your doors if you owe no one anything. Low or no debt is therefore crucial. The business model itself is a more generic issue that comes last. Do you think this company concept will stand up well in a challenging economic environment? Consider food stores. Since people plainly cannot stop purchasing the necessities, they usually do better during recessions. Insurance organizations. Just because someone is aware that their finances are a little bit tighter doesn't mean they will cease paying for their house or car insurance. On the other hand, you know that travel agency can suffer when prices increase and clients have less money to spend. Plans for the holidays could be abandoned when living expenses consume more of one's discretionary income. There are many elements to take into account, but for active investors, it is important to assess the pricing power and debt levels of business models. Then, passive investors simply continue to go long and maintain their strength. Overall, though, that is the reason recessions offer such enormous opportunities. And perhaps this video has given you the information to benefit properly. Well, there you have it. What do you think? Are we on a bullish or bearish market? Will there be a recession? Does it make sense? Do you agree? Or maybe not? Let me know your thoughts in the comments below. Wow, was that news? Why not ponder it? Want to know the latest? Comment if you want more articles like this. This video is just one of many videos on my channel that brings you the latest news about the world of global finance and economics. So go hit that subscribe button if you don't miss out on content like these. If you enjoyed this video, please hit the like button. Thank you for all your support, and I'll see you again next time. Remember, 1 penny lesson a day keeps being penny less away. Cheers.